Our movie Kill Me Now was successful, and now we're creating a franchise. Our sequel is going to be $15 million, and we're now putting the finance plan together for the sequel. Let's take a look at some of the funding sources and terms. Our sales agent, who represents the US rights as well as the international rights for this film, charges us 15% as a sales fee and 1% distribution expenses. This would be due on all worldwide distribution revenues. The sales agent agrees to defer all his fees due, including the fee that would be due on the down payment that is provided by the distributors for pre-sale distribution agreements. The agent agrees to defer all fees until after the senior loan has been repaid, which is our bank loan. The collection agent charges 1% on all collected gross revenues. And we're going to finance the film using the finance sources of the senior loan, which is our bank loan, the junior loan, incentives, equity, crowdfunding, in-kind services, music investment, and brand integration. The back-end profit participation agreed for the cast, director, and writer is 5% each. We're also selling US rights at a film festival, but we're not doing that until the film is finished, and we'll get 35% of the budget. So this component is not going to really help us with our finance plan because we're not getting this money until we are recouping. So it will be an item that will take place and will be received in the recoupment schedule. The equity profit participation is assumed to be industry standard, which is 50% of the invested amount in relation to the budget, and the equity investor gets 20% premium on the investment. The junior lender finances 1.2 million and expects a 5% premium as well as a 5% back-end profit participation. The only thing that is being deducted up front are the loan charges of $70,000. All costs and fees are deducted up front except for premiums and profit participations. So interest fees is something you would deduct up front. Any executive producer loan fees, legal fees, or any other fees that are noted to be deducted up front will be deducted up front. The revenues that we will be receiving are received at take price level. So even though we made pre-sales on the ask price level, the rest of the sales will be done on the take price level. And the bank looks at our pre-sales, which we did at the ask price level and have secured. The bank looks at these agreements and will say to us, I'm going to give you 90% of the license fees you receive from the Tier 1 territory, and I'm going to give you 50% of all the license fees you received from the Tier 2 territory. So let's integrate all these finance elements in special terms and costs and so forth, and let's take a look at what our finance plan, our funding schedule, and recoupment schedule will look like. Let's take a look at some of our funding terms. We are going to get a bank loan, a senior loan, and the bank will cash flow 90% of the license fee that is coming in total from the Tier 1 pre-sales and 50% of the license fees that are coming in total from the Tier 2 territories as license fees. So these two combined will become our pre-sale loan, and that will be subject to a 6% interest for the term. The term for a senior loan is normally between 18 and 24 months. The gap loan is applicable under industry standards and is subject to an interest rate of 8%. So the gap loan is driven by the unsold territories, but it also has a cap of 20% of the budget. We have a junior lender who is giving us $1.2 million and charges us a $50,000 executive producer fee and a $20,000 legal fee. Both is supposed to be deducted from the loan amount. The junior lender wants a premium of 5% and the profit participation of 5%. So the junior lender is not charging us an interest. Interests are charged up front and deducted from the loan amount. Premiums are charged from the revenue in our recoupment schedule. So this is where we're going to pay the premium for the junior lender later. So right now, all we need to deduct is the $50,000 and the $20,000. We are getting brand integration of $500,000. We're paying this agency 15% of that. Now the brand integration that is then net available to us is released in 2 installments. 50% we're getting up front, and we can use it to cover a portion of a production cost. And the other 50% we're getting when the movie is delivered and finished and done. So that will be part of our revenues later. We have crowdfunding for $500,000, and that is due to that is subject to a 25% commission that needs to be deducted up front. And then some of these investors, these crowdfunders, are requiring a profit participation, and it comes to 5% altogether. We have a UPM, a unit production manager, who would like to step up his career and become a line producer. And in order for us to do that, to allow him that credit, he says, I'm going to do the line producer job. I know how to do it, and I will therefore defer $150,000 of my fee. So that saves us basically the line producer fee of $150,000 that we originally had budgeted, of course. So now we don't have to pay that. In exchange, the line producer wants 5% profit participation. And then we have a music investment that will cover our music budget line item for $300,000. So we don't have to pay these costs either, which we have, of course, budgeted. So the equity is going to give us the balance of whatever is left that we have to cover our production budget, and wants a 20% premium on their money, and then we'll get a profit participation of 50% of the investment related to the entire production budget. Our sales agent went ahead and did some actual pre-sales for us, and in this case the pre-sales are done at the ask pricing level, which is great. So let's look at the pre-sales that we've gotten. We have sold the territory of France for a license fee of $1,500,000. Spain pays a license fee of $1,125,000. The UK pays a license fee as a minimum guarantee of $1,687,500. Australia pays a license fee of $937,500. The Middle East and South Africa each pay a license fee of $187,500. So these are actual pre-sales that were made. So that means we are now looking at our sales estimates of $11,976,000 as the take level, which is still the assumption we're using for our finance plan. So we're not going up to the ask level only because we sold our pre-sales on the ask level. We're still looking at the take level for our finance plan. So the entire take was $11,976,000, and now we have to reduce and take out the territories that we have sold. So when you look at the take estimates right now, you see that there are zeros in the column of France, Spain, United Kingdom, Middle East, Australia, and South Africa. So they are zeroed out. That means we basically just took away the territory we sold. On the take level, it is entirely irrelevant how much we paid it, because once you sell the territory, it is gone. It is no longer available for you as a collateral. So you have to look at these rights in your sales estimates as a bucket of rights. It's a finite bucket. There is each territory listed. And the minute you take a territory out because you sold it, you simply take it out. And then whatever money you get for the territory, which in this case is our ask price, is what you're going to use to take to the bank and have the bank give you a loan for. And in this case, all these distributors giving us 10% of a down payment, so we can use that down payment for our finance plan because it's given to us when we come to the closing. And then 90% on these agreements will be paid when the movie is delivered. That is the time when we then pay that pre-sale loan back, because at that time it is due to be paid to the bank. Let's apply all these finance assumptions and see what we, the producer, end up with in regards to profits. As always, we start with the project valuation. So we're looking at our pre-sales again. So altogether, we are looking at $5,250,000 in license fees coming from the Tier 1 territories and $375,000 in license fees coming from the Tier 2 territories. And altogether, we have pre-sales secured in the amount of $5,625,000. Of that, we get 10% paid right now because that's the down payment that the distributors are making. So we get in $562,500 and is marked green as in green money because it's going to be available to us to be used for the financing, and it covers a portion of our production costs. Now later when the movie is finished, we're going to get 35% from the US, but that is not available to us right now in this funding period because it's only happening after the movie is sold. Now let's look at the unsold rights. What happens here is we have $6,726,000 available in unsold rights because we took our $11 million and some change. We removed all the rights that were there, zeroed out those territories, and ended up with $6,726,000 left of rights that we can still sell. Now altogether, when we take our unsold rights, we add our pre-sales, and we add our US distribution, we end up with $17,601,000 altogether in revenues. So let's take a look at what our loan would look like, our senior loan. So remember, we had $5 million and some change in pre-sales for the Tier 1 territory. So the bank will give us 90% of that amount, which is $4,725,000. And the bank will give us 50% of the pre-sales that we secured in the Tier 2 territory, and that is $187,500. So altogether, the pre-sales that we have secured that the bank is now cash flowing, the bank will cash flow $5,912,500 after it applies the discounts for Tier 1 and Tier 2. That's what we're getting. Now we already received the down payment from the distributors, and the bank knows that. So they are deducting the down payment from us, which is $562,500. So we are left with $4,350,000 right now as a gross pre-sale loan. Now, that gross pre-sale loan is obviously subject to an interest, and the interest we were told is 6%. So we have to deduct $261,000 for interest payments that will be paid to the bank in the recoupment schedule. We're not actually issuing a check right now to the bank of $261,000. We're going to pay that later when we pay the gross pre-sale loan back. Right now, what we have available for us to fund a portion of the budget is $4,089,000. So let's look at the unsold rights. Earlier, we mentioned that our unsold rights value was $6,726,000. And if we look at the collateral that the bank would look at, we would have $3,363,000 available as a gross gap loan. However, our budget is $15 million, and the cap for this would be 20%, which is $3 million. So all the bank will give us right now for this reason is $3 million as a gross gap loan. They'll charge us an 8% interest on that, which is $240,000. So the net gap loan would be $2,760,000. So when we take together those two gross loans, which include our interest, we have to pay the bank back $7,350,000 later in the recoupment. And if we look at what we have available to cover our budget, it is a loan amount of $6,849,000. Our junior lender is very straightforward and says, I'm going to give you $1,200,000 for your movie, but I'm going to charge you some fees. I'm going to charge you an executive producer fee and a legal fee. So that's the $50,000 and the $20,000. So altogether, we are left with $1,130,000, which is $1,200,000 minus $70,000. Let's look at our incentive loan. We had a budget originally that was $15 million. Then we have in-kind services that are being deducted because Our line producer is not going to charge us. The music investment is covered. So we're ending up with a strike price of $14,550,000, and that is the amount of the actual expenses that we have, and that is the amount that is subject to the production incentive of 30%. So that production incentive is therefore $4,365,000. We have to pay the lender 15% of that, which is $654,750, and we have to pay an executive producer and a legal fee of $70,000, which leaves us with $3,640,250. Our brand integration is $500,000. We're paying 15% to the agency from that, so we're deducting $75,000. So we're left with a brand integration amount of $425,000. Now we're not getting that all now during the funding period. We're getting half of that now during the funding period, and we're going to get the other half in the recoupment period. We did a crowdfunding campaign and secured $500,000, and we had to pay an admin fee for that of 25%, so we are left with $375,000 from crowdfunding. The in-kind services and music investments are in relation to budgeted line items, and because they are being paid for, meaning they are specifically costs that we have budgeted but don't have to actually pay at this very time and moment, we can remove them from the budget when it comes to establishing the strike price. The strike price is the budget that is referred to as the actual expenses that we have at the moment we're producing the movie. That is the amount we have to cover because these are the actual expenses we're going to have. So that is why this is the amount that we're using when we're calculating the equity balance, and it's also, meaning the strike price, the amount that is used when we calculate the incentives, because the incentives are also driven by the actual expenses we have. So when we now calculate all the funding sources that we have secured, we get to an amount of $12,769,250. In order to meet our strike price of $14,550,000, we need equity in the amount of $1,780,750. That is 11.8% of the budget. To give you a complete picture of the funding schedule, I have copied it here, but I suggest that you go to the module and download the Excel sheet to see all these numbers clearer and be able to go through them on one page. Let's take a look at our revenues. So here we have our recoupment schedule. As you know, we are now finished with our movie. So it's finished, it's done, and we can now sell the US rights, which was 35% of our budget. The budget was $15 million. 35% of that is $5,250,000. We are adding our pre-sales to that, and these are the pre-sales that were done at the ask price level. So those were $5,625,000, and then we're adding the unsold rights because the rights that we still had to sell at the time are being sold at the take level. So that is $6,726,000. So altogether, for international, we're looking at $12,351,000. For these pre-sales, we already received the down payment of $562,500, which is why we're left with international revenues of $11,788,500. So if I look at my worldwide gross distribution revenues, including the US, I would get $17,038,500. Now we're adding the brand integration that we still due. This is the second installment payment that now comes in of $212,500. So altogether, our gross revenues are $17,251,000. So let's take a look at all our expenses. Our expenses are the collection agent. 1% of all our revenues would be $172,510. We have a bank loan, which is now our gross bank loan that is due, and this recoups before our sales agent can recoup. So right now in rank 2, we have our bank loan or senior loan recouping at $7,350,000. And next, we have our sales agent and expenses of 16%, which is 16% of all the worldwide distribution rights, which is $2,816,160. Then we're paying back our junior loan of $1,200,000. We're now paying a premium of 5% on that, which is $60,000. We are now paying also the equity, which was $1,780,750, and the premium on that investment is $356,150. So now that we're calculating all these expenses together, we get to $13,735,570. So when we take all these expenses and we deduct it from our revenues, we are left with $3,515,430 in net revenues, and we can now start paying profit participations. We're using our net revenues now to pay all the profit participations, and they're not paid in a ranking system. They're paid all at the same time. The equity investor gave us 11.87% of our budget and is therefore getting a profit participation of 5.94% of the net revenues. That is $208,670.07. The mezzanine lender or junior lender required 5% backend. That is $175,771.50. The crowdfunder that wanted a profit participation is also getting 5%, $175,771.50. And the line producer, remember, who deferred his fee, is getting also 5%, which is $175,000, again, $771.50. The talent pool, cast, director, writer, each had 5%, so that comes to 15%. So the talent pool is paid $527,314.50. So all the profit participations that we have paid now come to 35.94% and $1,263,299.07. Sorry about that. So the producer would be left with a balance of $2,252,130.93. So that is the answer to the question, how much profit is the producer receiving? So please go through this case study step by step. Also use the Excel sheet that is on the module and click on the cells and see the formulas to understand how these calculations came about in case this case study needs support for you. So that's a good way for you to understand how these numbers are established in the Excel spreadsheet. The Excel spreadsheet reflects a finance plan that you can use for your own projects and for other case studies in the module as we go forward. And it's definitely a good reference for you to use when understanding these case studies. And again, if there are any questions about this case study, please feel free to email me or let's set a one-on-one, and I'm happy to walk you through the case study in a meeting together.